Welcome everybody to our panel on what is next for monetary policy, and welcome to all our panelists. Before I introduce them, let me first hand over to Professor Stephen Bach, who is the Executive Dean of King's Business School, for a brief introduction. Stephen.
Thank you, Francesca, and good afternoon, everyone, and thank you for joining us. It's been a great pleasure to join you for this distinguished event and to get a deeper insight into some of the issues facing central bank policymakers and the consequences for economic well-being. The Qatar Centre for Global Banking and Finance is a demonstration of King's commitment to make positive change, and providing this global platform for discussion is an important part of the Centre's work. We had an excellent discussion already, and I'd like to summarise briefly what, for me, has been some of the key messages from the sessions today. Starting with our opening session this morning, the papers presented by Florian Bilby and Ambrogio Cessa-Bianchi address the important question of how the pandemic is affecting both the supply capacity of our economies and also overall demand. We're seeing growth bounce back in much of the world economy, but it's difficult to be certain how enduring these recoveries will be. These papers provided valuable insights about the nature of structural adjustments that will need to take place in different sectors of our economy and the implications of this for economic policy. The next session focused on whether central banks should reduce interest rates into negative territory if they need to stimulate a depressed economy. This is, as you know, a very much a live question in the UK and in many countries around the world. The papers presented by Florian Haider and by Matthias Rottner draw on the ECB's experience with setting negative rates. The key lessons from this experience seems to be that the effectiveness of this policy rests on the amount of headroom to cut interest rates on deposit accounts and how well capitalised the banking system is. Finally, our third session analysed the combination of low interest rates and low inflation that much of the world has been experiencing for the last decade or so, until, of course, interrupted very recently by a jump in US inflation. This trend has constrained central banks' room for manoeuvre in crises like the current pandemic. Leonardo Melosi's paper proposed the intriguing idea that central banks should commit to responding less aggressively when the economy overshoots its inflation target in order to offset this deflationary bias. Oliver Pafuti's paper looked at the implications for booms and busts in house prices and suggested that inflation targets should be increased in a period of low interest rates like the present one. These papers all tackle important issues and offer practical insights that help central banks in the extremely challenging times that we're facing. I'm very much looking forward to our next panel, and let me hand back to Francesca to introduce our speakers.
Thank you very much, Stephen. You touched on a lot of the important questions that are also going to be relevant for the panel. So since, the financial crisis of 2008 and even more since the recent COVID crisis, central banks have been intervening to support a growing range of markets and activities using instruments that go well beyond the interest rates and open market operations. On top of this, there have been calls for central banks recently to take on issues that are quite removed from their narrowly defined price stability mandate. And this, brave new world in which central banks are currently operating raises many questions around the efficacy of possible and the possible side effects of monetary policy tools, the adequacy of the existing monetary policy framework, and the validity of the economic paradigms underpinning existing policies. I am delighted to have here with us a really distinguished panel of speakers to talk about some of these key questions. Our panelists and chair need very little introduction. but let me just name them for you. So Argias Bordone is a vice president and function head at in the macroeconomic and monetary study function of the Federal Reserve Bank of New York. Frank Smets is Director General of the DG Economics at the European Central Bank and a professor of economics at Ghent University. Gert-Jan Vliege is a member of the Monetary Policy Committee of the Bank of England, and they are our panel. Today's chair for this session is Tobias Adrian, who is the financial counselor and director of the IMF's Monetary and Capital Markets Department. And so without further ado, let me welcome all the panelists and hand over to you, Tobias, to chair this very interesting, this session, which I'm sure will be very interesting. Thank you.
Great, thanks so much for the kind introductions. And I'm indeed very excited to have the panelists here, Argias Bordone from the New York Fed, Frank Smets from the ECB, and Jan Vliege from the Bank of England. So we are going to kick off the panel with roughly 5 minutes for each. So I'm going to start with a sort of like big picture, broad introduction, and then turn to Argia, Frank, and Jan to go a little bit deeper. This panel is really about the question, what is next for monetary policy? And as Francesca noted, it is about policy tools, frameworks, but also paradigms. And so where are we today? We have been through, the biggest economic crisis in about 100 years, or for some countries, even 200 or more years, such as in the case of the UK. And of course, the economic crisis was triggered by a pandemic. The pandemic is ongoing, even though some countries now have vaccinations that have been rolled out broadly. Many countries and the vast majority of people are still exposed to this pandemic. The deaths are continuing, and it is a really terrible economic and human crisis. Now, unlike in previous economic crises, policymakers acted extremely aggressively and extremely timely. For example, we have looked at the central bank balance sheets of the G10 economies, the largest 10 economies in the world, and they expanded balance sheets by over $10 trillion in just a year. Similarly, fiscal policy expanded by over close to $15 trillion in a year. So these are extraordinary amounts, very aggressive actions. And as a result, what we have seen is in the face of very deep economic crisis and health crisis, global financial conditions stayed easy, right? So we have seen record issuance of stocks and bonds, and in some countries, fairly aggressive lending because central banks have eased so aggressively. And so I think the first question that I have in the back of my mind for what's next for monetary policy, the first question is where are we heading to? So we just put out a GFSR a month ago, and the theme was an asynchronous and divergent recovery, right? So we already see that in health terms, where some countries are vaccinated and other countries are not. And many countries might have to wait for a long time before being vaccinated. So the pandemic, which is the underlying problem, this crisis, might continue in many countries around the world for some time. And as a result, what we see is recovery that has already happened in China. China is already back at pre-crisis levels of output. The US is expected to surpass even pre-crisis trends sometime next year. But then many countries are much slower in the recovery, and that is strongly correlated with income. Okay, so those that have lower levels of income tend to be expected to take more time to recover, have more scarring. So the kind of policy that is needed in different countries might be very different going forward. Last year, everybody needed expansionary monetary and expansionary fiscal policy. In the future, that might be quite different. That, I think, is one of the key questions. The asynchronous and divergent recovery means that monetary policy needs and the stance of monetary policy might be different going forward. A second question is very US specific. Of course, the US has introduced a new framework for monetary policy, which has average inflation targeting as a central element. And we have seen in the past 2 weeks, pretty remarkable inflation numbers. And many have the prior that those are base effects. Those are temporary shoot ups in inflation. But of course, you never know. There might be a more persistent component. So how do you operate average inflation targeting, which is really getting phased in now in the face of inflationary shocks that are probably temporary, but might have some persistence. So as you're learning about the persistence of the inflation shock, how do you make the framework operational? And then I think the third broad question is about monetary policy transmission. So when we look around countries, it was already mentioned in the introductory remarks, banks play a crucial role. And of course, in some parts of the world, the return on equity or profitability in the banks is very low. So how does monetary transmission work when bank profitability is very low? I think that is one concern, and we already see some of the surveys for senior loan officers that are showing some tightening of underwriting standards, which is certainly not what is intended by the monetary policy stance. Secondly, there are many small open economies that have used asset purchase programs for the first time. It used to be that only a handful of the largest economies used asset purchase programs. Suddenly we've seen this spread around the world. Many have used asset purchase programs. So how does it work when many central banks in the world are using asset purchase programs? How do we think about that? Finally, of course, is this question about the economic paradigms. So let me stop here with the introduction and turn to Ajia for her opening remarks.
Thank you, Tobias. So you put on the table a lot of questions, but you gave me a good introduction. Assuming that we have representative of different central banks, I will take the Fed perspective and try to answer the question in that sense. First of all, let me thank you for the invitation, and let me also say that whatever I speak about is representing my own views and not those of the Federal Reserve Bank of New York or the Federal Reserve System. So as Tobias said, obviously, everybody's realized that the post-pandemic landscape will be quite different from what we left behind. And the pandemic shock was quite different, not only affecting different countries in different way at different times, but within a country, affecting unevenly the more disadvantaged portion of the population. And this has made the situation more complex to address because in the US in particular, this has brought to the fore social and racial tensions that have been accumulating over time. And so the central banks central banks in the US, and I suppose in the other part of the world too, has to navigate the social political landscape that appears to put increasing pressure on taking a larger role in the public sphere. So the Federal Reserve hasn't already, if you want, a kind of step ahead, but it's not necessarily an advantage, a step ahead under a central bank because it initiated this review of the framework in 2019 and concluded in 2020. So now has a set of, a structure, a framework that is supposed to help moving forward. And what is this framework? This framework was formulated to take stock of what has happened after many years of what has happened during the financial crisis, and to take stock of the changes in particular that were not clear in 2012 when the first formalization of the framework with the long-run goals and policy strategies was formulated that was taking stock of the Bernanke Fed inflation targeting strategies. The situation presenting in 2019 was one in which two particular things had happened: a decline in the interest rate, and people in the audience have seen the pictures in the papers presented before. The decline along, in all the world of interest rate meant for the U.S. that the longer run federal funds rate, the rate that is consistent with the economy operating full strength and stable inflation, that was estimated by the policymakers had declined. And at the same time, the U.S. was able to achieve a very low unemployment rate, a 50-year low unemployment rate, without having a spurt of inflation, and it has remained actually consistently below the target. And these two elements pose a challenge. One, the limit to the conventional monetary policy space had increased the downward risk to inflation and inflation expectation, for which the standard inflation targeting policy was not successful, was creating downward bias, but also has challenged the estimate and usefulness, perhaps, of the natural rate of employment concept. And so the Fed, embarking in a much more broad contact with the public to listen to the people, has changed the approach to monetary policy, and Tobias has referred to the, having the average inflation targeting strategy. But the important thing, I think, to underline is that the focus of the Fed has shifted, partly under this broad pressure, maybe, has shifted from in terms of emphasis put on, apparently, on the dual mandate. One is the maximum employment goal that has been now redefined in the new strategy as a broad-based and inclusive goal, and there is no more reference to the natural rate of unemployment, but the Fed has a strategy of mitigate shortfall of employment from the assessment of what is maximum sustainable level. And the price stability goal remains set in terms of a long-run inflation target of 2% in terms of the standard measure of personal consumption expenditure price index. But also in the price stability is emphasized that there is a strategy of following period when inflation has been persistently below target to compensate with monetary policy that aims at the higher level of inflation. Now, this, as Tobias has posed, is a natural question to ask: how this framework that was formulated to assess a pre-pandemic challenge of a world of low interest rate, potentially higher incidence of ELB episode, consequent downward downside risk to inflation and growth, how can this framework help navigate the challenges of the next decade? And because the word that will emerge from the post-pandemic may not be a kind of secular stagnation word for which this framework was devised. And so one could argue, in fact, that this extremely strong support on the fiscal side has created, in the environment that this has created, is now, at least in the US, much more favorable to larger intervention of government in the economy, especially if this intervention may be directed to, help the lowest tier of the population, help with structural productive uses, together with perhaps the technological ingenuity spurred by the pandemic, might improve economic prospects and economic trend. And at the same time, the forces that have been depressing inflation by the globalization are in retreat to some extent. And so in this case, the framework may also be harmful. And in fact, as Tobias mentioned, the recent data show consistently a big spurt of growth in the US, a spike in inflation that had not been seen before. And so there may be concern that the Fed is perhaps now less attentive to inflation because of this pressure of pushing the maximum employment goal beyond what was considered once the structural limit. So I mean, this is a question that it would be nice to debate. I would argue, I would take a view that the new Fed strategy has shifted gears, has put strong emphasis on the employment mandate, has acknowledged that tight labor market may help also income inequality, although has not embarked, as some commentators say, in a war on poverty explicitly. But this doesn't imply that the Fed will disregard what happened to inflation. At the moment, the view is that the spike in inflation was expected. Perhaps it's been a little higher than expected, but there are a number of particular situations that do not point necessarily to a persistent increase of inflation beyond what would be the catch-up of inflation for having been low. And the Fed has put in place a strategy that should maintain a focus on inflation expectations, because those are the guarantee that inflation will not skyrocket. And so the important thing is that 1 month of inflation data are not enough to make an assessment of the pattern, and inflation pressure may develop over time, and the Fed has the tool to put in place to counteract this. And so the two objectives will have to be balanced or traded off in a continuous way, following what the pandemic world will appear, and not only in the US, but in the rest of the world, because with integrated economy, the US may spur growth in the other parts of the world, or they may be affected by the fact that, as Tobias pointed out, many other countries are falling still behind. And let me stop here, and hopefully we will pick up on this more in the Q&A.
Yeah, thanks, Agia. Absolutely. This question about inflation in the US at the moment is certainly the focal point for markets. So let's turn to Frank from the ECB.
Thank you, Adrian. I should, well, first of all, I cannot really report on the outcome of ECB's strategy review because it's still ongoing. And we sort of expect an announcement on this outcome in the second half of this year. And so it's definitely not my task to preempt that announcement. In that context, I would also like to say that what I say is my own responsibility and not that of the ECB or its governing council. Secondly, it's also difficult to do a strategy review in the midst of a crisis. And of course, our review was announced by President Lagarde in January of last year. Then it was stopped for a while and restarted last summer. And so now we are very much still in the midst of the process. So what I would like to do in my few introductory minutes is discuss basically three issues that are within the scope of our review, and that also were very much discussed in the conference today. And are also, of course, addressing some of the questions that Francesca posed to us. Now, I think Tobias's questions were more sort of on the current policy stance and the current situation. So maybe that I will cover if there's time in the rest of the panel. I mean, just 4 points. I mean, the first point is that, I mean, obviously, the starting point of our review is basically what is said in the treaty, which gives the objectives of the ECB. And so that has not changed. That's taken as a given. The primary objective of the ECB is to maintain price stability. But the ECB is also required to support general economic policies in the EU with the view of contributing to these other objectives of the EU, which of course include balanced economic growth, which include full employment, social progress, and also environmental sustainability. And I think sort of this sort of dual set of these two parts of the mandate are important in reviewing the strategy. Secondly, the current strategy of the ECB basically was designed at the beginning of EMU, so more than 2 decades ago, and basically reviewed last time in 2003. And so, of course, since then, many structural changes has happened, including, of course, the financial crisis and the pandemic crisis. And the purpose is really to see whether that strategy is still fit for purpose. And probably the most important change, which also was discussed at the conference, is the fall in the equilibrium real interest rate, which basically means that central banks will spend, monetary policymakers will spend much more time at the effective lower bound. That has a number of consequences that we need to address. And of course, the Fed strategy review gave one particular answer to that. With respect to what is the appropriate formulation of the price stability objective, how effective are all these new unconventional tools like asset purchases, the negative interest rate policy, but also targeted lending operations in sort of circumventing the constraints on the conventional interest rate interest rate policy. And thirdly, to what extent do we need to also have sort of an asymmetric reaction function? And there was one paper that by Melozzi and co-authors that kind of addressed it, in case the unconventional tools are not sufficient to fully achieve the inflation aim. So that's a very important set of issues that we are looking at. A second and the third point is that, of course, there are also these other considerations. And Argia emphasized very much the objective of full employment and balanced economic growth, which is, of course, part of the dual mandate of the Fed, but which is also important, obviously, for the ECB. But then there is also financial stability, and there again, Tobias, of course, has written a lot on that objective, and the financial crisis has raised a number of questions on the importance of financial stability considerations in the strategy review. And finally, there is the environmental sustainability, which is one of the big challenges, or the biggest challenges for humankind, I would say, in the coming years. And so there's a question how that affects central banks' monetary policy strategies. Now, here I would like to say, of course, this raises a number of questions on whether central banks are at risk of overreaching their mandate, of being overburdened, with, of course, consequences on what it means for independence and accountability. But I think it's important to make two points, two obvious points. I mean, first is that each of those other considerations that I mentioned have direct implications for the working of the economy and for the ability of central banks to achieve the price stability. And so at the sort of a simple level, of course, it is important that central banks look into those areas, also in order to achieve their price stability. And in many ways, achieving price stability is complementary to these other objectives. I mean, full employment is an obvious case in the current circumstance, where there's still a lot of slack and particularly also hidden unemployment in many areas, including in the euro area, but also financial stability. If we think about the response that Tobias mentioned in the beginning of central banks to the outbreak of the pandemic, particularly in March. Again, there was a big complementarity between central banks reacting very aggressively and strongly in order to address the market malfunctioning that was taking place, and the mandate of stabilizing the economy and maintaining price stability. So overall, I would say when we think about many of these other considerations, it's really about how central banks achieve price stability rather than making trade-offs between those objectives and the price stability objective. And of course, when we, for example, one example is the impact of negative interest rate policy on bank profitability and bank interest rate margins, which clearly is there, given that there seems to be somewhat of a kind of a lower bound on the interest rate on deposit, and so on funding costs of banks. But no, when designing the operational framework, one can mitigate some of those effects. For example, by having a tiering system, or by our targeted long-term refinancing operations. So these type of, if you want to call them financial stability considerations, can be taken care of in the context of pursuing price stability. Now, of course, there are other considerations. A final topic that I wanted to address is sort of the interaction between fiscal and monetary policy, but maybe to save some time, and I can keep that for the discussion. Back to you, Tobias.
Thanks, Frank. So our third panelist is Jan Verniger from the Bank of England.
Thank you, Tobias. The economic impact of the COVID crisis was completely unprecedented. In the UK, we had the largest GDP contraction in 300 years. It was not just unprecedented in size, but also in how unevenly distributed it was. So it's always the case that in recession, some sectors suffer more than other sectors. But the COVID crisis was completely unprecedented in the sense that some sectors almost completely shut down, so it fell by 100%, while other sectors were much less affected and some sectors even benefited. The policy response was similarly unprecedented. We had the largest ever peacetime rise in the fiscal deficit, and we had the largest ever increase in the Bank of England's balance sheet. Now, it's going to take some time before we know exactly how successful these policies have been, but I would say so far so good. The unemployment rate in the UK has only risen by about a percentage point, despite the fact that annual GDP has contracted by 10%. And that's because the government's furlough scheme has protected people's income as well as their connection to their employer. And so, as I've said before, and several of my colleagues have said as well, fiscal policy has done the heavy lifting in this downturn. There has been significant help from the Bank of England in keeping borrowing costs low and ensuring orderly functioning of funding and asset markets, so that credit provision throughout the pandemic has generally worked well. A strongly capitalized financial system was able to help firms absorb the shock with the help of the Bank of England. This year, the unprecedented contraction in GDP is likely to give way to an unprecedented rate of growth in GDP, such that by the end of the year, we expect to have regained the pre-COVID level of GDP. There's some temptation to call that a boom. I think it's more accurate to call that a prospective return towards normal. And during this prospective return towards normal, we should also be prepared for some erratic price moves, as not all sectors will open at the same speed, and that may create some temporary bottlenecks. And these temporary price moves, along with significant base effects, are likely to push inflation above our target temporarily later this year. Thinking about what's next for monetary policy, the immediate concern is to keep the current stimulus in place to maximize the chances of a full economic recovery with a smooth transition out of furlough. Thereafter, we can return to the question we already started asking before COVID, namely, in a persistent low interest rate environment, do we have adequate monetary policy tools available to deal with future downside shocks? And of course, I ask this question asymmetrically because our tools are asymmetrically constrained. We have plenty of room to tighten, but we have limited room to ease further. The Bank of England will be adding negative rates to its toolkit from August this year, and that's an expansion of our policy room for maneuver that I very much welcome. Thinking about QE, the experience of the past year has reinforced some elements that I had discussed pre-COVID already, namely that QE can be very powerful during periods of market dysfunction. But when market functioning has returned more or less to normal, and in an environment where long-term interest rates are already low and inflation expectations are consistent with the targets, QE cannot deliver a great amount of additional stimulus. Economic prospects now are better than they have been probably at any time over the past year, thanks to the rapid rollout of vaccinations. But we're not out of the woods yet. Globally, new COVID cases remain high. In the UK, cases have fallen to quite low levels, but on the virus front, we're still dealing with so-called variants of concern, which may yet affect the pace at which the government can ease COVID-related restrictions. On the economy front, we still have the wind down of the furlough scheme ahead of us. And while we expect that most furloughed workers will be reintegrated into the labor market smoothly, this process is subject to significant uncertainty. We're talking about millions of workers, and even if only a small share of them end up in unemployment later this year, that could lead to a rise in unemployment that is still of macroeconomic significance. The fact that we're going to have, or we're likely to have, temporarily high growth rates and temporarily high inflation in the coming months is not the main concern of monetary policy. Instead, monetary policy will focus on returning inflation sustainably to its target, which requires focusing on the medium-term outlook for inflation and therefore the medium-term pressure of demand on supply rather than transitory factors. And as I've discussed many times before, I think we will continue to find ourselves in an environment where the neutral rate of interest, meaning the rate at which monetary policy is neither stimulating nor putting the brakes on the economy and inflation, is very, very low relative to the past several decades. That was apparent before we were hit by the COVID shock and will remain relevant once the COVID shock has passed. Thank you.
Thanks so much, Jan. That's very insightful. And I was thinking that I would turn to the questions of the audience next. So we have a number of questions, and perhaps we turn around the order of the panel. So we start with Jan, then go to Frank, and then to Ajia. So two questions that came up were, first of all, by Martin Wheel, who's at King's College, who used to be on the MPC. What is inflation persistence going to be? As I alluded to earlier, there are base effects that are putting up pressure on inflation in some countries and certainly in some sectors. So there's lots of sectoral dispersion in inflation. But is this just like a temporary blip and monetary policy should look through them, or could there be some persistence? That is one question. The second question by Daniel Hinge from the centralbanking.com outlet is about Janet Yellen's reference to the high pressure economy. There could be benefits to the supply side, i.e., people that were out of the labor force could come back in. There could be sort of like very, very beneficial effects, in particular on the labor market, but also in terms of productivity more broadly. So is it good to run an economy hot? And then finally, the third question is by David Eichmann. In the event that we see persistent inflation, will central banks come under pressure to stop paying interest on reserves? So that's the third question. So three questions. Let me just repeat. The first one is about the inflation persistence. Is there any grounds to think that inflation is going to be persistent, or is it just a blip? It's a base effect. that will go away as the economies are getting back into running after the pandemic. Secondly, the high pressure economy question. Does that have beneficial effects on the supply side? And thirdly, if there is persistent inflation, will there be pressure to remove interest on reserves, so interest on excess reserves, of course. So let's start with Jan this time. Jan.
Thanks. You want me to do all three, or you want me to pick one?
As you want. I mean, I don't think we can do all three. Can't do all three. So you could pick one, and then we go.
Okay. So I'll say something about the high pressure point, and I'll say something about interest on reserves. But one of the things that's caused a lot of confusion about this downturn is the fact that in addition to there being a big drop in demand, there was also a big drop in the supply capacity of the economy. And so, to an approximation, you can think of furloughed workers as just having been removed temporarily from the supply side of the economy. And that caused, for example, the Bank of England to make statements that even though some spare capacity, significant spare capacity had opened up in the economy, the spare capacity wasn't nearly of the order of magnitude of the actual drop in GDP. And some people were quite confused by that. And I think that what causes the confusion is you have to be very careful when you make these statements about a temporary reduction in supply, because what we mean is that, yes, right now, this very instant, there may not be the kind of spare capacity that you would expect in an economy which is running still at 8% below its pre-COVID level. But the fact that we know that these hits to supply are largely temporary means that over the coming quarters, the economy has to grow very fast in order to keep up with that increase in the supply capacity as the furlough scheme comes off. And if the economy doesn't grow very fast, then a very significant spare capacity will open up. So sometimes people take that point to mean, it means that the economy doesn't need much stimulus then. And I think that's a big misunderstanding. No, the economy needs a lot of stimulus because the restrictions on supply are temporary. And as these come off, demand needs to grow very quickly to keep up with that very rapid increase in supply. So that's how I think about that. And then the question about, are we going to come under pressure to stop paying interest on reserves? If it turns out that there is persistent inflationary pressure in the economy, then what the Bank of England will do is we will tighten monetary policy through some combination of raising interest rates and unwinding some of the QE. If we stop paying interest on reserves while the balance sheet is still very large, then we can't do that because we won't be able to raise interest rates. Because precisely in order to control overnight rates, when we have ample reserves, we need to pay interest on reserves. So I really don't see how that's consistent or how that will help. As a matter of fact, it will be counterproductive to dealing with the persistent inflationary pressures.
Thank you, Jan. That's very clear. So, Frank, you want to go next?
Sure. I mean, I think I can, well, first of all, second what Jan was saying on both points. I think I would very much agree with that. And on the issue of the high pressure economy and sort of how much slack there is in the economy, it will be very important, as also in the euro area. Now we have this inflection point and some of the sort of restrictions and containment measures are released. We will see a strong pickup in growth, but that will go only part of the way to bring the economy back to full capacity. And so that in the euro area, we expect this to happen in sort of the first half of next year, with quite a bit of heterogeneity across the countries. And so the focus will have to be very much on the level of GDP and its relation to potential. And of course, that raises the question to what extent the potential, the supply side of the economy will be permanently affected by the pandemic. I mean, to the extent that indeed the pandemic kind of releases the resources, we should expect the sort of the scarring to be less than in recessions that are more driven by financial crisis and financial factors. And of course, there is evidence, empirical evidence around that. But of course, we don't really know. And it's also clear that part of the impact of the pandemic will be to transform the economy to a more digitalized economy. Some sectors will not fully cover. So there will be a need for reallocation and relative price adjustments. And that of course, confuses a bit also what we see on the inflation front. I mean, the current rise in inflation, we also perceive, and it will continue throughout this year, to receive this as temporary. Part of it is base effects, but the other part is really relative price changes that will again wash out after about a year, towards the end of this year. Now, on Martin's question about inflation persistence, I mean, if we look at sort of the empirical evidence for the euro area, I mean, first of all, I mean, we still see a Phillips curve that is there, but very, very flat. And I think what we see in terms of core inflation is consistent with that. But we have also seen an increase in at least the measured persistence of inflation. Now, part of that is basically inflation expectations also adjusting to the relatively long period of low and below target inflation in the euro area. And of course, I mean, that can reverse if inflation picks up and is higher than expected. But that kind of reaction is really also a persistent reaction. So I think the evidence we have so far in terms of the impact of the rise in inflation that we see now on, for example, wage setting shows that basically there is very little kind of pass-through of this rise in inflation. But I think as central banks, we obviously need to be sort of aware of the possibility that what has been a very flat Phillips curve may become relatively steep when sort of supply, the more permanent supply constraints are hit. But we're very far from that in the euro area.
Thanks, Frank. That was very clear. And I think the contrast between the euro area and the US these days is quite striking. In terms of anecdotal reports, of course, you do hear a lot about shortages of goods, of supplies, and you know that has a pricing impact. So, Ajia, any further additions on those three questions?
Well, I mean, a lot have been said. I think I second many of the things that my colleagues have said. I think that the US is in a situation, as you pointed out, sort of ahead of the game, because we seem to have had, partly because of the vaccination success and the ability to reopen ahead of time the economy, put us with this expectation of a very strong growth for this year and probably the next. So the question is to see the medium term, as Henry was saying, try to be, not to be overreacting to the last data of the moment, but try to see through this. Inflation persistent has been declining for a long time, and we don't know. I mean, making prediction those days and relying on time series is very hard to use this period when there are this bounces up and down. Certainly is. I think the central bank and the Fed should be vigilant. Should not dismiss. Let me put it this way: should not dismiss the signals, even though the the baseline projection is that this spur of inflation are temporary. Should not make a prediction on the basis, say, of the used car prices that have gone up 10% in a month, because there are a series of factors that generated this, and they are fading over time. So people will, start to use more confidently public transportation, for example, to go back to work as opposed to necessarily drive a car. So it's very hard to interpret the contingency because we haven't experienced it. So the important thing is to maintain communication with the public. I think one of the, going back to my question, we have a new structure in place. The Federal Reserve has a new framework in place. Would that be successful? I think the important part is that the Fed maintains the conversation with the public, explain what it's doing, and maintain the trust, continues to have the trust that was eroded tremendously with the financial crisis. And now with the strong reaction and the cooperation with the fiscal authority, I think he's regaining trust. And the important thing is that he has explained the new strategy, the way in which it applies, and not appearing to dismiss inflationary scare, not overdo at the same time. Thanks.
Thanks, Ajia. And the trust, of course, is the basis for any central bank credibility. So I think we have time for one more round of questions. So I noted three sort of leftovers that the three of you mentioned, but didn't have time to expand. So perhaps we can expand a little bit on them. So one is about the monetary fiscal interaction. Here again, it's in many countries we have seen very, very strong fiscal actions combined with very strong monetary actions. I would guess that it's a combination of the two that really has strong benefits. And of course, a number of central bank governors have called for fiscal action that, monetary policy alone cannot solve all the problems. So any further considerations around that? Secondly was the issue about financial stability. So we see asset prices are fairly lofty in many segments. And of course, easing financial conditions is an intended outcome of asset purchases and of easy monetary policy. So are there risks at some point to financial stability? Do we have the macroprudential tools to address them? And then the third segment is about climate. So many central banks are looking at climate and how that relates to their inflation objectives, as Frank pointed out. Of course, even if you don't have a climate objective or a financial stability objective, the inflation objective or the dual mandate of the objective is tightly interlinked with those issues. So how do you think about climate? Is this going to play a major role in the framework going forward? So why don't we start with Frank this time, who was in the middle, then Jan, and then Ajia can finish up. Frank.
Maybe let me say one word on fiscal and monetary policy mix. I mean, I will not sort of repeat what you said, Tobias, about the importance of having sort of the appropriate policy mix in the current context. And clearly, there is a broad consensus that this time, in response to the pandemic, fiscal policy is one of the policies that is at the forefront of the response for a number of reasons. No, we know that at the effective lower bound, discretionary fiscal policy is more effective in stabilizing the economy. No, fiscal multipliers are higher, but also because of the reasons that Jan mentioned, the pandemic shock, of course, is a very specific shock that affects different sectors, different countries, different households differently. And clearly, fiscal policy support is a much more targeted instrument to help households and firms to kind of bridge the pandemic crisis. And finally, this is related to the impact on potential. We know the pandemic crisis, or we think the pandemic crisis accelerates some of the structural changes. And again, this is where fiscal policy, by basically increasing public investment and encouraging private investment in the areas of climate change and greening the economy and digitalization is important. But it doesn't mean, as you emphasize, that monetary policy is either useless or unimportant or ineffective. Indeed, I think it's key that monetary policy preserves the favorable financing conditions for all the sectors of the economy, including the government, to ensure that the economy recovers and inflation sort of reverts back to the inflation aim. I mean, on the climate and environmental sustainability. Okay, actually, let me not address it and leave this to maybe Ajia or Gert-Jan.
Okay, so Gert-Jan, you want to go next?
Sure. So on the monetary fiscal interaction, there's just a couple of points I want to reiterate. So first of all, the way that I think about it, and I think the way that my colleagues think about this too, is that there was an enormous shock. There was a very big fiscal response, and there was a very big monetary policy response. The monetary policy response was there because this was a disinflationary shock that needed stimulus. The monetary policy response wasn't there because the deficit was big or because the government issued a lot of bonds. It was there because the economy needed it. And of course, those two things happened at the same time because, like you said at the beginning, all the actors of countercyclical policy acted very quickly and in large size. But there was no causality from one to the other. We were both responding to the economy. And then a related point is, obviously, when we lower interest rates and when we do QE in order to also lower long-term interest rates, that lowers the cost of borrowing for the private sector and also for the public sector. But the fact that it lowers the cost of the public sector is kind of a side effect. That is not the primary intended effect. The primary intended effect for us is to support private sector spending so that we can meet the inflation target. And the lowering of government borrowing costs is a side effect. That's not why we do it. On climate change, what I will say is as for the MPC, the mandate is that our primary responsibility is the inflation target, and only subject to meeting that inflation target are we asked to support the government's growth objectives, which include a sustainable growth objective. So I want to be very clear that there is not some sort of trade-off between climate objectives and price stability. Price stability is absolutely primary, and the climate objective in the context of the inflation target only enters if we have met the inflation target, and then we, subject to that, we support the government objectives. Climate is a much more important consideration on the financial stability side of the bank, but since I'm a member of the Monetary Policy Committee, not of the Financial Policy Committee, I won't say any more about that. Thanks.
Right, and so Ajia, you get the chance to wrap up the panel.
It's a big responsibility. I would say that this completely agree that the monetary policy would not be as successful if there were not for fiscal policy going along it. The shock was unprecedented, and I think it's taught us a lot of lessons in how much we need to understand and the granularity of the economy and how it works. And it's very important that central banks and have maintained within their mandate, have sort of enlarged their views. So the climate change is not in the mandate of the Fed, but it affects the financial stability, and in that respect, the Fed is addressing the issue. And the maximum employment is in the mandate, and so acting, balancing the objective of price stability and the maximum employment is part of the mandate, and the Fed will act on the mandate. So important, as I said, it's maintain the vision of the medium term while the short term develops with a lot of bumps along the road, as we should expect it for as a consequence of this unprecedented shock. And time is up, I guess.
Thank you, Ajia. That was very nice. So with that, we are at the end of the panel. Thank you so much for everybody to participate. We covered a lot of ground, and of course, we can only scratch the surface of many of the issues. But I think we learned a lot, and thanks for having us.
Thank you very much. Thank you very much to all the panelists. It's too bad that we only had an hour. I was considering we could have, several hours to kind of go in depth in the issues. So, thank you. This has been a really kind of interesting end to a very overall really interesting day. I hope to see as many of you as possible tomorrow for our second day of the conference. And I would also like to remind you that on the conference platform, it's possible to view the posters of both the poster presenters, but also of the PhD students that have been shortlisted for the Young Economist Prize, which will be announced tomorrow. And with that, let me thank again both the panelists, Argia, Jan, and Frank, and the chair, Tobias, for a really insightful discussion. And with that, good evening, and I look forward to seeing everybody tomorrow. Bye.